So to kick us off, I thought I'd start with some of that data that Andy was referring to previously. We've got some slides for you. So you can see here what the institutional investors who we surveyed, what they see as kind of the key risks that are being over and underestimated. And what really jumped out here from the Investor Pulse survey is that the one that investors see as most mispriced, whether that's under or over estimated, is of companies defaulting on their debt. And European investors, actually, we found, are particularly worried about this risk. So, April, I'm going to turn to you first. Can you unpick this for us based on what you're seeing?
Well, I mean, if you look at the default data, it barely moved. And that's the weird thing. You know, if you look back at history, when interest rates have gone up a lot and stayed high, that tended to trigger defaults. Kind of logical. But the weird thing is it just hasn't really happened in any kind of way that you could sort of look at a chart and go, aha, I can see where companies are struggling. Now, the reasons why are kind of as usual. It's complicated. You know, businesses have learned something. They've had a few economic cycles, so they've been running things a little bit more, shall we say, sensibly, so leverage not as high as perhaps you would have normally expected after the period of growth that we've enjoyed post-COVID. Some of that's down to inflation being high, interest rates high. Why am I going to lever up when it's so expensive to do so? So that's caused some sort of more cautious corporate behavior. The other thing is, of course, high-yield companies have had money thrown at them by private debt and private equity firms. So it's very difficult to default if people keep giving you money. So that's been helpful. That's wonderful. I mean, you know, if somebody is going to fund these businesses, they will survive. So it's a couple of different things, but overall, it has meant that people have been worried about defaults that never really came. And you can, the previous panel talked about banks, and they've all provisioned against bad loans, and those bad loans never came. So they've been writing back some of those provisions, which has obviously boosted earnings. So you can kind of see it across the board, and it's definitely curious and not what we would have expected.
Yeah. How about you, Rob?
Yeah, I mean, I think on that part of it, you know, we have seen a big increase in liability management exercises. So these are sort of, they get calculated into the default rates that a number of the agencies use. But again, these are proactive views. There aren't accidents sort of waiting to happen. And part of what's going on too in the corporate side is, I think, you know, one of the other guests noted it, is companies have been proactive about their balance sheet. You know, the fear of default is a fear of, typically, like was just mentioned, liquidity. We all know what the bad businesses are, but if there is capital to continue to support the business, then there's likely capital. I'll give one example. I came over here in 2003, and there was going to be all this investment from all these lander banks that were going to be, you know, selling their bad loans. Nothing ever happened because the Germans said, why are we going to sell this to distressed debt investors who are going to make 15 to 20% when we can just restructure this ourselves and earn something more modest? So again, if there's capital out there, the default outlook probably is a bit more modest.
And what do you think, Lloyd? Is this being over or underestimated?
I mean, it's being underpriced, right? So as investors, we're not getting compensated for the risk. But as both speakers have said, I mean, it's just functional liquidity. You know, if there's money chasing these assets, then, you know, these bonds will get rolled over, loans will get rolled over, and the company keeps going. And, you know, and whether you think that's ultimately a good company or not is another thing. But at the moment, there's plenty of companies out there that certainly we wouldn't touch, that other investors are quite happy to lend to. So I think I don't think, you know, I don't think the investor base is necessarily blind, but I think there's so much money out there that it needs to be put to work.
And Dan, how about you? Do you think the default risk is being mispriced?
I think when we approach these, we have to think about a range of possible outcomes, and it's too easy to grip onto one narrative, and it seems to us that that's what's happened in the markets, that people have been lulled asleep by the fact that we have overestimated defaults up to now. We went through a really important stress test over the last few years with rates going up, and defaults didn't happen, and so what's the logical next step is people say, oh well, there's probably going to be a continuation of capital coming in. We can all see what's happening in the private markets, and that gets reflected in spreads. But historically, we haven't been very good at forecasting defaults. It was very easy to see it in hindsight, but difficult to see it with foresight. And so then we go back to that point that Lloyd made. So, are you being paid to take that risk at the moment? And we would say that typically you're not being paid to take that risk. And we'll talk about that. There's a lot more, I'm sure, in the rest of the panel. But so the question is not whether generally defaults are being overestimated, but what's reflected in price. So we think there's a lot of there's a lot of positivity reflected in prices. We don't think investors are getting paid.
And then I just want to turn more specifically within corporate credit. So one sector that's been talked about already on the previous panel is financials and bank credit specifically. Lloyd, I know this is an asset class that you invest in and feel quite positive about, and we've seen quite a lot of bullishness towards the asset class, particularly post Donald Trump's resounding electoral success. Can you talk us through kind of where your regional preferences lie within this segment and what parts of the capital structure that you particularly like?
Yeah, I mean, it obviously has been touched on by the previous panel, and I think firstly we've got to look at bank credit, insurance credit, whatever, in the context of kind of credit markets as a whole, and we all know that credit spreads are tight here. But nonetheless, financials and I'd say probably banks in particular, but also to a degree insurance companies, it's kind of like the best looking horse in the knacker's yard, right? I mean, but by some margin, because we know credit spreads are tight. But the thing is about financials is that you can pretty much hide in them. That's the nice thing about financials, because whether you're in senior debt, whether you're even in AT1s. If you're in short-dated AT1s and they're paying you 6%, 7%, 8%, it's a great place to be. I mean, because you're getting paid an awful lot of yield with not a great deal of price risk from credit duration, right? And that's the beauty with financials. You've got a lot of short-dated bonds. Yeah, there's lots of it, and sometimes the market can get over its skis and get a bit long financials, and you get maybe slightly more volatility in credit spread. But the reality is that there's lots and lots of short-dated financials yielding a lot, and the fundamentals of the sector are actually really, really good at the moment. And even if default rates pick up, I mean, they're still really, really good. Banks now make money. And the first line of defence against losses is actually profit, let alone capital levels and provisions, and so financials look good, and then regionally, I mean, it comes down to valuation, right? Because such was the post-financial crisis response in a regulatory sense, that actually the banking systems are generally in damn good shape. So the US, I mean, the US has some really good, really strong large cap banks, but you don't get paid. So you kind of you go down into the next best looking bunch, and the European kind of national champions look really good still from a credit perspective, particularly in what we used to call the pigs, and they look particularly good, and you get paid a bit more. So I think we got a preference for Europe over US, but that's that's purely on a valuation basis, and generally I'd say extend that to the UK as well. You get in some cases you get paid a little bit more again in the UK. So I mean regionally it's purely now down to kind of valuation.
Yeah, lots of positivity on the pigs today. April, do you also think financials are a good place to hide at the moment?
I wouldn't say hide, but because of what's been happening in terms of banks becoming safer post-financial crisis, and banks not being that keen to lend, which is sort of a strange thing to say, but a lot of the risky lending that used to happen is now other places, in the private markets. So that's interesting because it sort of de-risked the banking sector. So that's appealing. I have to say, though, we're quite interested in duration. So although short-dated bonds do look interesting, I think in the financial space we're quite happy to go out the yield curve as well, expecting that they're going to be cutting interest rates more than probably is priced in now. So there's some opportunities, but generally, yeah, we like insurance companies, we like banks, we also like things like utilities. So it's a bit of a kind of a barbelled approach.
And how about you, Rob? Are you keen on financials particularly?
Yeah, we are. We probably have a small preference for U.S. over Europe. Again, driven by fundamentals. I think there was a question earlier about the growth outlook for Europe being too dour. It's probably not dour enough. China could grow 10% tomorrow. Germany's not going to sell many more BMWs. And so, one of the questions that we have, again, if we are going to talk about fiscal in Germany, so we're going to get supply from the UK, from France, from Germany. That's a lot of bonds to take down in Europe. And so, as we think about, we all sort of know what the US fiscal is, which isn't great either, but we sort of know that, right? What we don't know is what the supply outlook could surprise to the upside in Europe. And so, again, a small preference for the US over Europe.
I think we're also in that camp, to be perfectly honest, it wasn't necessarily something that the first panel touched on, but I mean, to my mind, when I look at the US, they're going to have a go at austerity, actually, and Elon said, and Elon, as Trump likes to talk about him, he's clearly very fond of the guy, but he said himself, this isn't going to be without pain to start with, and so I think in line with your point, the narrative probably needs to shift a little bit on fiscal from the US to probably Europe.
Yeah. I think that's Elon Musk's involvement is probably one of those known unknowns or unknown unknowns, as Sir John Saws called it earlier, given he doesn't have an actual government department, but is obviously clearly very influential. So we've touched on it a little bit already, April. I know you said you like utilities, but just looking beyond financials, what are the sectors that you each like the look of going into 2025? And more to the point, kind of how does this relate to what you're actually trying to achieve in your portfolios for your clients? Perhaps Dan, you could kick us off.
Yes, sure. So we've just published our outlook for 2025, and the purpose of that really is to put everything in that portfolio context. Because obviously, I'm sure we'll all say the same thing. It's not just about picking one thing that you like, but it's the job it does in that portfolio. And so when we think about the fixed income parts of our multi-asset portfolios, then the job it's there to do is really provide that diversification benefit that we've been talking about. So we get the diversification not just from global equities outside the US, but also from fixed income. So if you're using an asset primarily for diversification, then the quality of that asset is really important, as well as the value. And so we're favouring government bonds in our portfolios. So the G4 Treasuries, also like emerging market debt to some extent. That's a different part of the portfolio. But the primary holdings are in the big government bonds, because although they don't always react well when equities draw down, they're about the most reliable asset that you can have. And we think one of the dangers at the moment is that people are trying to use that part of the portfolio to reach for additional yield. They're being a bit greedy in the diversification part of their portfolio, and that's where we see some of the potential trouble ahead. So we're sticking in what people think of as very boring, but typically reasonably predictable government bonds.
And Lloyd, anything that's boring or not boring outside of financials that you're particularly keen on?
I think what's kind of usually classed as boring, but we actually don't think is boring from a credit perspective, is actually utils, oddly, because we see just a lot of issuance, and whether it's kind of UK water or it's grids in particular. We think grids are going to groan under the weight of demand for electricity, particularly from AI, and so we're going to see a lot of bond issuance. While some of these companies might be a good equity investment, from a fixed income side, we're going to see a lot of bonds. So we're not that keen on utils. I suppose we don't like credit duration in particular, because as we said, kind of credit spreads are tight. So we don't feel the need to take all that price risk from credit. But so I think it's keeping it short, keeping the yield up, and the yield is actually at the short end. And just not taking a great deal of price risk really from credit duration, because we kind of see at the moment that the kind of diversification benefits of fixed income is actually a short dated yield. And to my mind, that's going back to fixed income investing in the 90s, the 80s, the 70s. That's what fixed income investing used to be before we had a period of negative correlation between bonds and equities. But you go back for the last 250 years, and there's a nice piece on the Bank of England Bank Underground blog about this, and actually, bonds and equities are correlated. And you've got a presence of any inflation at all, and bonds and equities are correlated. So your ballast and your diversification from a portfolio perspective is your short dated yield. I think.
And is that a view that you share, April?
We sort of separate the credit duration from the interest rate duration in portfolios. So, we could see the sheer momentum in fixed income increased allocations to credit by maybe multi-asset portfolio managers, or people who say, okay, as long as inflation is below 3.5%, you have maybe it's recent financial history, past 50 years, seen that negative correlation play out. So comparing dividend yields to corporate bond yields, always dangerous. They are different things. We know this, but we're like, wait a minute, actually fixed income does look attractive. So when you see money going into an asset class, it just tends to make it go from expensive to really expensive. And from the interest rate perspective, and this might sound controversial, but whether it's the right thing or the wrong thing, interest rates are likely to fall. And, debt financing costs for governments around the world are getting to the point where they're a problem. And although central banks are independent, they don't operate in a vacuum. So we just think, well, they're just going to, I don't want to say cave, that sounds too, they're going to be influenced to consider whether the environment, whether they want to make sure they have that very narrow landing strip of soft landing and don't mess it up by keeping interest rates too high. So the sort of arguments for interest rate risk we can see won't be a straight line. There'll be plenty of volatility, but that's fine. But the credit side, markets don't look cheap, but boy, they can get more expensive. And so that is kind of how we see those two risk attributes.
Well, I hope you can cheer us up a bit after that, Rob.
No, but I know it maybe came up in some of the prep calls, and I don't want to steal anyone's thunder on lines, but maybe a bit more constructive on a high yield. Again, it's high yield, not high spread, right? Do you want a bond yielding a coupon of 3.5% at zero rates, or do you want a bond yielding you 7.5% at 5% rates? And so, when we were issuing high yield bonds in the threes, I was reminded by the quote in The Untouchables, "I've become what I beheld, and I'm convinced I've done right." Right? And so, think about a portfolio that's 50%, bonds and 50% equities. Something we have today that we didn't have for the decade before was coupon. So now let's say you got a 6% average coupon on that 50%, every 6 months you're deciding what to do with 1.5% of your portfolio. That's a big number, and that's a big number for an allocation shift. Again, it's just sort of a basic maths on a 50-50 portfolio. So again, while we're not necessarily overweight a ton of high yield, we're more neutral on the asset class. And I think the other thing that, to maybe square the circle on that, is floating rate, right? And floating rate offers opportunities, both investment grade and non-investment grade, and it also sort of points to private markets as well. One of the things that didn't come up there is the risk in private markets, and private markets are largely floating rate bank loan type stuff. So how do we, there's risk, but are we overstating that risk in some of those markets?
And then you touched on high yield there. There's actually been quite a lot of pessimism about that segment over the course of this year. I'd like to get some of the other panelists' thoughts on that. Is it time to look at this segment again, or is the uncertain inflation outlook too much of a deterrent, Lloyd?
Would I jump in now? No, is probably the answer. Because high yield spreads are tight, and we're not giving up much by being in investment grade. Yeah, there's one or two opportunities in high yield, but there are also plenty of those companies that are just being kept alive by liquidity. I mean, we can kind of talk about credit fundamentals. We're not worried about credit fundamentals at the moment because there's plenty of liquidity. If there was less liquidity in the market, we'd be worried a little bit more about credit fundamentals, right? And be thinking that actually some of these companies, just Asda and Morrison, for example, I mean, they don't look good, and they're only being kept alive by liquidity. And so, from a credit perspective, we don't feel that we're being paid to go down in credit quality, and we also don't feel like we're kind of missing out, and it feels like that kind of market at the moment. Whether we're kind of in for credit fundamentals is questionable, or we're kind of in for FOMO, and it's arguably an easier trade in credit than it is in equity, because there's not a great deal of upside in credit now in going into the lower reaches of credit versus being kind of up in quality, I think. So I think, we don't feel like we're missing out, I suppose.
And what about you, April? Are you willing to take the risk, or are you playing it safe?
It's really hard at the moment because we can see, some companies who are clearly going to survive. They've got really good credit metrics, and yes, the yields are sucking money into that asset class. Particularly Asian clients are still very keen on high yield, given where yields are. The problem is that when you look at relative value of IG versus high yield, and you risk adjust it, and you look back over 20 years, it doesn't look that attractive. It's kind of on the expensive side. So if you're looking at a multi-asset credit portfolio and you can go anywhere, you're going to be in an IG. That doesn't mean you're not going to have some selective companies in high yield, but if you're just looking at the asset class level, it's not a compelling, I must have this type level.
Yeah. And Dan, you've already mentioned your preference for government bonds. Would you go down the quality spectrum at this point in time?
I'm going to violently agree with my fellow panelists. There's just not a lot there. If you want returns, then we still see some great opportunities in the equity markets, outside some of the areas that we've already talked about, and so that's where your capital returns can come from. There are times when everyone hates high yield, and they offer some really great opportunities. We're not there at the moment. We're at a point, as you said, April, where everyone loves high yield, and also, as Lloyd said, a lot of these companies are being kept alive by that continuous capital flow. So that's another way of saying that it's being kept alive by positive investor sentiment. Well, I don't think that that's a sustainable investment strategy. And when investor sentiment turns for whatever reason, and we very seldom are able to see that in advance, that's when suddenly we see these blowout in spreads. And of course, because it's investor sentiment driven, it's normally when equity markets are doing poorly as well, and that's where your diversification typically fails. And that's when you have clients who really wish that they thought about diversification beforehand rather than afterwards. And so no, we think that in an environment where there's plenty of returns elsewhere, then picking small spreads, and I would say it's quite small yields, but certainly small spreads out of the high yield market is not a sensible thing to do.
Mm-hmm. Preference for equities generally, though.
Preference for absolutely. In terms of, I mean, the benefits of being a multi-asset investor, of course, that I'm not thinking just within the fixed income environment. It's a different conversation, but from a multi-asset perspective, we think there's plenty of returns on the equity side.
Mm-hmm. So just to move on to another macro risk that our survey identified, we noted that European investors, in particular, around 40%, say that the risk of tariffs, which has already come up in our previous panel as well, clearly front of mind, being imposed by the US, and also the growing debt burden there are being underestimated. Is this chiming with what you're hearing from clients, and how do you perceive those risks, Rob?
Sure. So we definitely hear from clients that they're concerned on the U.S. fiscal, and the U.S. fiscal is a concern. It's on an unsustainable trajectory, right? U.S. debt held by the public is going to double over the next 10 years. So from about 25 trillion to 50 trillion of debt, absent some changes. So it is a concern, and again, it really goes to maybe one of the questions as to why spreads are tight. You'll have a meeting with someone and they'll tell me how much they hate their spreads, but then they'll complain about U.S. Treasuries at 4.25% when they can get 7% from a company that's paying you back, right? As opposed to someone who continues to. So you sort of have that. The reason why spreads are where they are is because yields will only go so high, right, before someone will get attracted by it, but governments are continuing to issue. So we are concerned, and when is there a moment on the U.S. debt? It's tough to say, right? When that'll happen. We have seen term premium get reintroduced into the U.S. curve. We've seen the ACM term premium increase over the past 6 weeks or so. So there is some in there, but clearly this is a focus from clients on the U.S. debt.
Yeah. Are clients also talking to you about U.S. debt levels, April?
Yes, but the problem is, I'm going to use a sort of probably not very nice analogy for some in the audience. Smoking is bad for you, but you don't know when it's going to impact your health. And this is the problem with going, I'm really worried about, debt levels have been rising for decades, and government bond yields have been up, they've been down. So there's not a sort of obvious, when debt levels are high, it causes a sell-off in the government bond market. I mean, we can see there are moments when people, shall we say, panic. I'm thinking trusts. Look what's happening in France. So there are some moments where markets get nervous about debt levels and debt sustainability. But it's hard to sort of make a sort of investment policy around it. I'm going to say something a bit controversial, but if markets get disorderly, they will buy bonds. And there won't be a moment's hesitation. So this sort of fiscal repression of keeping yields, at a level where the government can finance itself, trying to keep markets orderly and functioning, and I don't see any, reason to think that they would back away from that. And that applies in Europe in the same way that it applies in the U.S. And clearly they did it in the U.K. when things got disorderly. So it's not that, that's not a reason for governments not to ultimately do something about these high debt levels, but they do have a sort of tool to calm things down artificially, one might say, if things do get disorderly.
Yeah. And what do you think, Lloyd?
Yeah, I mean, I agree with that ultimately. The number one concern of any central bank is the solvency of its sovereign. Ultimately, that's the number one concern. However, I mean, they've got to be kind of forced into that. It's travelling and arriving. But everyone we speak to is concerned about US debt levels, and the kind of start you're thinking post-election. I don't know why, because actually there's quite a big change in the US now, right? I mean, whether they kind of are able to cut the budget deficit or not, there's just we've got to move from big state to holistically, philosophically, a smaller state. They want to get the deficit down. Yeah. Besant wants 3% budget deficit, and they put in this Department of Government Efficiency, and so it's not easy to cut the spending, but they're going to have a go at getting from 7 to 3, and that's a big chunk of GDP.
Yeah.
And so I think I'm less concerned about US, but and the policies also on the private sector side on the US should keep the private sector really taking over. Yeah. And so you kind of think the denominator side in the US has got a chance of growing as well. But then you look at Europe, and whether it's the UK or Europe, actually, well, I mean, things are pretty challenged on the denominator side. And also, there's, you look at the UK. I mean, there's no way this government's doing austerity. If they don't get the tax they think they're going to get, they're just going to borrow more because she's made the headroom for herself. And then you look at Europe, and politically, nobody wants austerity. So and the growth side is challenged. So I genuinely think debt sustainability in Europe is probably where we should be looking now, post-US election, rather than the US.
Yeah. And just a final thought from you, Dan, on that, looking on a relative basis, do you think, is it perhaps not surprising that European investors are focused on US debt burden levels when they should perhaps be looking a bit closer to home?
Yeah, well, yes, you always see the fly in someone else's eye rather than the problems in your own. So I think that's right. You're seeing that concern, but the thing we have to remember is that the US, particularly the US Treasury market, is the biggest, deepest capital market. So if you don't like the US and you're concerned about the impact that would have on global risk appetites, where do you put that capital? It's an enormous amount of capital to move, and we haven't really seen those concerns translated into another recipient of that capital. So I can see why Europeans are concerned. It's right to be concerned. As April said, we don't know when it'll have an actual impact, but it's tough to see how those concerns are expressed beyond potentially the currency. And again, when we see the dollars being relatively expensive compared to a lot of currencies, and yes, there's obviously plenty of arguments, as we heard earlier, about the dollar going up, but that's often the way that overseas investors are expressing their negativity, not necessarily by yields going up in those countries' bonds.
Yeah. I'm conscious of time, but do you want to give the audience a chance to ask any questions before you proceed to your coffees? So yes, if we could get a mic to him.
Gervais Williams from Premier Miton. I was going to ask about tariffs. We don't know what the tariffs are going to be or how bad they're going to be. I don't think Trump likes Europe very much, so I suspect, I think we've probably got a bit more coming to Europe than we want. But specifically, with tariffs you get deflation. And with deflation you get profit margins coming down. Surely that's going to be something which is enough to move bond prices. Certainly spreads between high yield and lower yielding bonds.
Who wants to take that?
Well, yes, if the tariffs are just one way, but I'm kind of the mind that Europe doesn't sit back and just say, actually, okay, yeah, we'll have 20% tariffs on our goods and not put anything back on the US. So I kind of think that ultimately we get tit for tat tariffs if we get them, and that's just it's kind of inflationary for everyone. And it's a deglobalization, and it's just friction, and it's just tough environment for, it's stagflationary really rather than inflationary, and it's just a bit of a mess and a tough environment for not only US, not only Europe, but kind of US as well. It was quite interesting that the Mexicans said, well, if you put tariffs on us, we can put tariffs on you. But certainly Europe sees themselves as an equivalent trading bloc, and I don't think Europe will kind of sit by and not put tariffs back on the US.
The only thing I would say there, and I think Christine Lagarde showed her hand last week, right? She had the article in the FT talking about how Europe should be proactive about buying U.S. goods in order to avoid tariffs. So let's look at what she didn't say. What she didn't say was, obviously, if they do tariffs, it's going to make growth even worse. And the ECB would prefer not to cut rates. You look at Nagel yesterday saying Germany should look at the fiscal debt brake. The ECB, for whatever reason, does not want to cut rates and rather do this on the fiscal side or on the tariff avoidance side. So I think hearing both of those central bankers speak tells you that the tariff, even though there may be a back and forth, it'll impact Europe worse than it would the U.S.
Well, we promised you a gloomy outlook.
We didn't get to the UK.
Oh, well, exactly. There's more that could be said there. April, Dan, any final thoughts on that?
Gosh, there will be tariffs. Trump always follows through with his most unfortunate plans. They might get a bit more nuanced. I mean, I've seen a few different estimates on what a tariff war would cost the U.S. household, and the numbers range between sort of $1,200 per annum per household to $2,000. Clearly, that's not okay. So we would imagine there'll be a bit more nuanced approach as opposed to a 10% from everything in Europe. But of course, Europe buys a lot of liquid natural gas from the US, so I'm sure they could come up with some sort of arrangement where instead of buying so much natural gas from the Middle East, perhaps they import more from the US. Yeah, it's not going to be great, but at least companies' profit margins are incredibly high. There's never been a point in history where you've had higher labor costs, higher input costs, and profit margins have gone up. So I guess you're starting from a good position if you're running a company.
Yeah. Place to be.
I've got nothing to add.
Well, that's very helpful because we are at time and I'm sure you're all very keen to get a coffee now. Thank you very much to our great panel.